Okay, welcome everyone, and I am delighted to host another fund manager interview here. And welcome back. Been a while since we've had him on. Harley Grosser from HG Capital Partners. Harley, how are you?
Good, Mark. Good to be here.
Maybe, yeah. I mean, you've been kind of around the microcap, small cap space for quite a while now. But yeah, maybe for anybody who doesn't know the HD name and the kind of philosophy in terms of stocks you're looking for and investments that kind of make it into the portfolio. Maybe just give them the quick 101 on stocks that you're running the rule over.
Sure, happy to. So, HD Capital Partners, some of your viewers might know us as Capital H Management. We're the same business, running the same fund, but we did a rebrand in 2023 when Dan Sims joined as co-founder and co-CEO. But we are the same structure and same strategy behind all that. So we specialize in investing in smaller companies, typically sort of sub 500 mil market cap. I think the sweet spot we've found for buying new ideas tends to be 100 to 300, but we're flexible around that range. It just tends to be where we find the most interesting ideas. We do have a really open mandate. That's quite different for funds in our space, and we structure it that way from the start. We can invest anywhere. So over the almost 8 years we've been running, very selectively we've found some private stuff that we've invested in because we think investors should have exposure to it. Some of those have done very well. We've got two of those in the fund at the moment that we really like, but 80 to 90% of what we do, and probably always will do, is Aussie listed small caps. We've got all our money alongside clients in the same strategy. So Dan and I would be the biggest investors in the fund by some margin if you combine them, which I think investors like that alignment. Like I said, been going 7.5, coming up to 8 years. Had a good run. Of course, not been a straight line. We've gone through a couple of cycles there with COVID and the 2022 tech crash and things, but funds back up near all-time highs. Whatever index you pick, we've significantly outperformed it, which has been nice after all fees, and it's been a good journey. So I'd like to think we've gotten a little bit better at what we do every year over those almost 8 years.
Yeah, it's been a packed 8 years, that's for sure. If you think
Certainly has.
COVID in there, the boom after COVID, the I mean brutal kind of like bear market we've had in the micro small end kind of between let's say late 22 and up until about we were just talking off air there kind of April May this year where I think that performance at the large cap level has kind of filtered down, and we've come off a very strong reporting season, very strong first quarter to FY26 for microcaps, but having had such a bear market behind us, I think we're really only at the start of what I think is going to be a good 26, 27 for microcaps. Just given a lot of the work that has kind of gone on balance sheets and cap raises and just really knuckling down on operations. There's a lot of businesses have really got their house in order and are, much better businesses than they were, back in 22 or when they maybe listed with a big listing boom there in 21, 22. And yeah, I think they're probably better businesses now than when they're listed, and the share prices, while they might have ran a bit in the last 4 or 5 months, they're still, not back at even IPO prices.
No, I agree. I would totally agree with all that. I think the flip side to it being difficult in smalls over the last, say, 3 years is that it's been a buyer's market. So we've just kind of had our head down. There's been so many good stocks to look at, so many right in our sweet spot of business we can understand and value, and we think the downside's limited. So it's really only now that we've got our head back up. Probably I haven't seen you for a while. It's been busy picking stocks, Mark, but we're back now. So yeah, hopefully it is the start of a trend for small cap catching up to large cap performance.
Yeah, no, exactly. And as I said, yeah, there's definitely been a buyer's market. If you've been doing the work over the last 3 years, you've had a good opportunity to get in at the ground level on a few stocks that now I think the market will probably be looking at a more favorable eye and be more rewarded. But and let's talk about the first one of those. Stock been around for a while. IPO'd. I can't even remember when, but it's been around for a while. They presented on here once or twice. It's going back a few years ago, and a few other managers have talked about him. Is Laserbond, a business that it kind of comes into vogue, goes out of vogue. They've done different strategies. Try the US expansion. I think the last time I looked at it, that's kind of been put on the back burner now for the time being. But a really high quality business though at the back of it.
No, I agree with that. I think that last point's really key there. So I know some of your viewers would know of Laserbond, some maybe don't. So I'll give a basic overview to start. But Laserbond's a surface engineering company. Like I said, been around a while. They founded in 1992, I think it was. And they use what's called laser cladding technology to massively extend the wear life of components and equipment used in heavy industry. So clients are in industries like mining, construction, infrastructure, defense, anything you can think that the equipment gets really badly beaten up are probably a client of Laserbond. They've got a nationwide presence of sites. That's very important, which we'll touch on later. They're the clear leader in laser cladding technology, although we can talk about competition and alternatives. And then in terms of how they actually make money, there's three segments. So there's services where a client like, say, BHP may have a drill bit or some other piece of equipment, and they'll send it into Laserbond, pay a service fee. Laserbond will refurbish it with their technology, send it back out to the field. That's actually been, like you said, a pretty steady grower for a very long time. We think it's a really good revenue model, and even more recently has had a couple of record months, which is great. The second division is product. So in product, Laserbonds sell a component or a piece of engineered product that has Laserbond's technology applied to it. And the clients in there are typically global OEMs. So the simplest way to think about it is that they will provide a small component into a bigger solution that these global OEMs are providing. They've had these clients for decades, but they become pretty ingrained in the supply chain. And then for better or worse, which is one of the reasons why stock got cheap, if that client, that massive global OEM has a great run, Laserbond will do very well. If they don't, for whatever reason, that's a risk they have as well. The third segment, just to round off the revenue model, is called technology. That's basically where they are building a laser cladding modular laser cladding piece of equipment, sell it to a client, earn a margin on that, and then they'll get at the back end a form of sort of, I guess you'd call it license royalty revenue as well. But that's the smallest segment in the group. And then to round that off, they do have a 40% stake in a business called Gateway. Gateway is WA based. It's quite amazing, but until they made that investment in Gateway in early 24, despite obviously having a big presence in mining, Laserbond didn't actually have a direct site in WA. So we think there's huge opportunity to leverage there. They were sending a lot of it to their South Australian business unit at the time, I think from memory. So they own 40% of that. They do have an option to go to 51% at any time from now. I think that's probably pretty likely to happen at some point. And the remaining shareholders of Gateway have an option to sell their shares in any quantity to Laserbond. So probably reasonable to assume at some time they'll end up owning at least 51% of that business too.
Okay. And yeah, as I said, it's kind of had its ups and downs, and obviously, tied to kind of the cyclicality of construction, mining, to for better or worse. But I guess what's kind of attracted you to Laserbond at the minute? What's kind of the investment thesis you're kind of looking at for the story right now?
Yep. So it kind of goes back to your first point, Mark, when we started on Laserbond, is that it is a high quality business. It's, for a very long time, it's been growing revenue at double-digit CAGR. Obviously, there's ups and downs like any normal business, but over the long run, that's been really strong. Good margins, founder-led until recently. The founder's still on the board, but it's a new CEO there, but founder-led for most of its life. All the characteristics that small cap investors do love, and for that reason, it did trade on a big premium multiple, 20 times plus PE, I think, at one point. And you could say it might have been overvalued for where it was at that point. A lot of stocks were in 2021, but it also has some good qualities about it. We always watched the business and liked it, but it was just, we're cheapskates, we're value guys. It was too much for us. And then more recently, what's happened is two things. So one in their control and one out of their control. One is the product division. I mentioned that they're sort of exposed, better or worse, to the performance of a global OEM. Now, one of those global OEMs had an ERP upgrade, and I feel like you'd see it too. ERP upgrades never seem to go smoothly, right? So whatever
Never,
happened, they lost.
never, ever.
Exactly. They cost more, they take longer, and then something goes wrong somewhere. So this is a pretty standard story. Out of Laserbond's control, through that, I believe they lost some visibility on their orders and their inventory. And so their ordering patterns with Laserbond just became unpredictable. In one half, they were very weak. Obviously, the market doesn't love that, right? Because it hits revenue and earnings. And that part of the business, which had pretty much just steadily grown, all of a sudden people worried about it. That was one piece of why the stock got cheap. The other piece, and overlaying these two, is probably that the market, small cap market, also fell, which made the stock cheap as well. But the other fundamental piece was that because the services business in particular was growing and has continued to grow so strongly, was hitting capacity, and they needed to make an investment, which they made in the first half of the prior financial year, 25, to expand capacity. So bringing in skilled people, ensuring that they can actually handle the revenue growth they expect. Because for Laserbond, demand's not actually a problem. They have plenty of unmet demand in existing and new clients. That's not their issue. So they had to make that investment. At a similar time, you have product revenue come down and margins look really bad. And obviously, the market's pretty unforgiving. It was coming from a very high multiple, and the stock got hammered. I think it went from $1 or close to $1 to, I think the cheapest we bought stock was maybe low 30s. So
Yeah, I was going to say,
that's a
didn't it
big
get to
fall.
around 30? That's kind of a numbers in my head as well, around that 30 cents level.
Yeah, exactly. It's a big fall. We took a view when you do this, you can get comfortable on the quality of the business. You never know when they're going to start turning around. But if you get comfortable on the quality of the business, and in most potential outcomes, the stock is very cheap, then we're happy to take a swing at it and make an investment. But now I think it took us a while to build our stake, but now it looks like, based on their second half of the end of last financial year, and even commentary they've made so far at the results, that they've turned the corner. Products starting to order normally again. The global OEM was back to a normal ordering pattern and should just, I think, resume normal growth over time. And services continues to hit records. So had a really strong second half. If that's sustained and Gateway performs as expected, nothing too flash, but just what it's been doing already, it's probably on 10 times PE. And for us, that's just too cheap. So it's a really simple thesis. We like the business, we like management, they're all aligned. It's a long-term growing company that had a short-term issue, and we've bought the stock.
Yeah. And if we maybe flip the coin on, that's the investment thesis, we flip it around to kind of some of the risks. Obviously, Wayne Hooper, who was, one of the founders, the long-term CEO, now he's now kind of moved on to the board. New CEO, new chief in the hot seat. Can be, again, sometimes it's a bit of a double-edged sword. We've seen that work and not working in other instances. But yeah, maybe just touch on, I guess, maybe some of the risks or some of the things you're kind of keeping an eye on, that they don't turn into maybe bigger issues.
Sure, sure. So yeah, you touched on that. There's a new CEO there. Any change of management is always a risk. We feel comfortable, but that'll be management's got to prove themselves over time. So we'll see. But have every reason to think that they'll do a good job. I think in terms of risks, when we were researching the stock before and as we were buying, we spent a lot of time on competition and alternatives. And it definitely is true that there are alternatives out there. So Laserbond to our understanding, the clear market leader in laser cladding technology in Australia. And the fact that they've got sites all over Australia now is a big moat. So we feel confident in that. But there are other technologies, chrome plating, nickel plating, things that are actually cheaper for someone like using BHP to take a broken piece of equipment. In that example, BHP, they might be losing, tens of thousands of dollars of revenue per day that the equipment's not actually in the field. And so turnaround time is really important. So while laser cladding and Laserbond clearly gives the best return in terms of the extension of the wear life, there are cheaper options that can get it back into the field quicker. So we spent a bit of time on that. I think one thing that offset that for us was this new quick response team initiative they've done everywhere, on all their different sites in Australia. That's really important, because if the cheaper alternative was a selling point because they could get the equipment back into the field faster, and Laserbond can now match that, it's kind of a no-brainer to go with the one that offers a better longer-term ROI. That's one piece. But competition is a risk, right? So a lot of the Chinese alternatives have caught up in quality. We spoke to supply chain managers and different customers, and they did say, look, versus say 10 years ago, they have caught up and are a potential threat that Laserbond has to continually innovate to stay ahead of, but that there was still a significant gap. They're cheaper, but there's still a significant quality gap. I think supply chain managers are very conservative people generally. I'm generalizing a bit there, but they're not going to switch for a cheaper price and lower quality, because often this is mission critical equipment that needs to work. And if you're stuck in the business, you're providing your business like a PHP or whoever it is, and you're working, it's going to take a lot for them to switch to an alternative. But that's a risk that we think investors should keep in mind. You did mention mining. Mining's cyclical. So if you're going to invest in Laserbond, you have to, at least to some degree, get comfortable there. People smarter than me are saying mining services is a good place to be at the moment. I don't know if that's true, but it seems to be going okay. But you have to get comfortable there. I think, you can go back. Laserbond's been listed forever, as you said. You can look at their numbers in mining booms and mining busts, and what tends to happen to them versus more of, say, a pure drilling company or something more directly exposed, is revenue goes up during a boom and then it kind of flattens for a bit as it sort of smooths out and then grows again. So I don't think it's an existential risk if we had a big mining bust, but it's just something to be aware of. And the final one is the obvious one of, management. They need to do a good job and execute. I think tariffs are something to keep in mind, which is Trump has reminded us of. At the moment, there's almost an advantage because the tariff on Australia is much more favorable than Chinese alternatives selling into the US, for example. But who knows? That could change any minute. So something to watch.
Yeah. And Laserbond, actually, one of the companies I was talking to, somebody we were just commenting on, the amount of early AGMs we've had this year. We had a lot of companies do their AGM September, nearly straight after the annual report, as opposed to the traditional kind of late October, November timeframe for company AGMs on the ASX. Their AGM is still coming up. So maybe just talk to us about, what you're kind of looking out for, if they've generally given an update, and then if we look on another, 2, 3 months and the first half result in February.
Yeah, so AGM is around mid-November from memory, so that's still to come. I think that would give an update. I wouldn't expect anything too specific unless it's materially above, or fingers crossed doesn't happen below where the market expects them. But we think they're trading well at the moment. The equipment sale in the first half is also going to help profits, and they're cycling a weak first half 25. So the first half result, if the AGM update doesn't look strong, the first half result almost certainly should, just by comparison. So I think that's something to watch. Medium term, I think, as I said, they're likely to increase their stake in Gateway at some point. I think the option runs to March 27 or 2027 at some point. So we like that business. I think management like that business. There's an agreed multiple. They buy it at 4.5 times. So I think they'll go to at least 51% at some point, any day from tomorrow to 2027. And then I think we touched on it before we went live, I think, Mark, but they did at some point look to going into the US. The tariff and policy environment made that too difficult, and the stock price being weak, nobody wants to raise at a weak share price. So we really respected the decision to put that on hold, by the way. And I think that's genuinely been put on hold medium term, just focus on all the growth happening in Australia. But 2-3 years down the track, the US customers are actually pulling them into the US. They want them to come there. They're not just doing it because they think they have a good idea. They're being pulled by demand. So I think over a 2-3 year time frame, perhaps there's a US acquisition or a US move for Laserbond as well.
Okay, yeah, interesting. We'll keep an eye on it, and see how they're traveling now at the AGM. We're going to completely flip industries and fields here now, for the next one, moving financial services and platform provider Praemium.
Yeah, Praemium, PPS. So Praemium, I'm sure a lot of your viewers know Hub24, Netwealth. They're very well-owned stocks and well-known businesses. A big part of Praemium is very comparable to those companies. They are challenger platforms or independent platforms like a Netwealth and a Hub are, versus the legacy guys that used to be owned by the big institutions. And all three of those independents have and are continuing to ride that wave of money shifting from legacy to independence. It's a very gradual shift of about 2 to 3% of FUA every year, but it's a massive market. The simplest way to explain Praemium's business model is there's two parts. On one side is what you'd call the custody side. This is the side that's more akin to a Hub24 or a Netwealth. It's call it your investment platform, supermarket for buying investment products. The advisor can administer, if you're a client of an advisor, Mark, can administer your portfolio, put you in different things, send you tax reports, track performance versus benchmarks or my fund and all this sort of stuff to get detailed analysis and help the advisor in providing a service to you. They earn revenue.
That's the advisor run their business, basically.
Yes, exactly. They sit on the Praemium platform. Often, we'll get to this later, but often they sit on more than one platform and administer clients, but it depends. One differentiation I should point out with Praemium is that they have and always have focused on the higher net worth segment versus a Hub and Net Wealth, which have a larger retail base. So the average client portfolio in a Praemium is larger. There's a broader selection of investments. They have more in private markets, and it's kind of just, by their smarts, but also luck in the last few years that high net worth and private markets are both the fastest growing segments. So they've become flavor of the month, despite doing that strategy for 20 years. But just on the revenue model there, so they earn, like a Hub and a Net Wealth, they earn a percentage of FUA, percentage of funds under administration. They earn some transaction fees, and they earn a cash margin. And then that business is called Spectrum, by the way. There's a few products, but the main one is Spectrum. On the other side is what they call non-custody. This is called Scope and Scope Plus. Now, Mark, if you are a client of, let's say, Taylor Colson, or you are a client of Shaw's, or maybe a Wilson, any of these big broking houses or wealth advisory groups, and you go onto your platform to check your stocks, and you can see what you own, and you can get a tax statement each year, and maybe you've got some stocks you own, but you've also you're a high net worth client, Mark, and you've got private equity funds, and you've got water rights, who knows what wealthy people own, that can all be reported onto this solution. Now that'll be branded as a Taylor Collison as the broker, but it's actually typically for most brokers, because they're the leader in the market, premium software that's sold B2B and powers all of that solution. So I think the market's not fully aware, but Praemium are by far the clear leader in what they call the non-custody side. They are significantly bigger than Netwealth and Hub. The revenue model is a bit different. They charge revenue per portfolio. So it's more a typical SaaS business. So for better or worse, you don't get the ups when asset values grow or FUA grows, but you also don't get the down. So it's more resilient. I think that competitive strength is one reason Netwealth did try to buy Praemium a few years back, but we can talk about that later potentially. But that's the offering and the business model.
Yeah. So yeah, let's talk about that. There's always, I think, in this space, the platform space, a lot of chat on takeovers, mergers, acquisitions, purely because people just realize putting them together in some way, shape, or form, there's just huge synergies to be made, and scale. Having scale in this business, a lot of it really does drop to the bottom line. So there's always the bits of scuttlebutt in the AFR about this deal, that deal. 90% of them don't eventuate, I would say. But I just people just inherently recognize the benefits of putting these together, extracting the synergies, getting more scale, and kind of the leverage that comes with it. So yeah, maybe just talk about what the attraction is now, and you can touch on maybe there's a potential for acquisition in there somewhere. I know it's not a reason to invest or buy a stock, but it's there in the ether, in the background, as a potential in this industry, just by its very nature.
No, 100%. So overarching the thesis is the everyday possibility that you could wake up one day and it's been acquired at a 50+% premium because of those synergies you mentioned. And someone's tried before and it happened tomorrow, I wouldn't at all be shocked, but that's definitely not the core of what the thesis is, and we'd be quite happy if they just don't get acquired. And I'll sort of run through why. So Praemium was one of the first independents. I think they started early 2000s. they have grown revenue in the Australian business. Forget the international business that was sold a little while ago. So you strip that out, look at the underlying numbers of the business that remains today. The Australian business revenue has grown double-digit CAGR over that time. There's not many businesses in Australia that are listed that have done that. Those that have tend to trade on crazy multiples for good reason, but Praemium is one of those. And then I think the first question I get, or we get, and I'm sure management get the same question when people are first looking at Praemium is, okay, you're small and hub and net wealth. How do you compete with them? I think there's three really important points to run through, and it kind of ties into why we like the stock. But one is you just look at market share over time. So it's a massively growing market. The independents are taking share as a group. If you go back roughly 10 years, Praemium had 0.5% market share. Sounds little, but it's a huge market. Net Wealth has 7.9 or 8, right? So even the big guys in the independents are relatively small. But they had 0.5% share in 2016, I think it was, and they had 2.5% share this year, maybe a little bit more now. But they've consistently increased their overall share in a growing market, right? Like the overall market is effectively the wealth of Australians. You're taking a percentage on FUA, which is listed equities, private equity, private assets. And so that's a good thing to be long over the very long term. Markets can go up and down in the short term, but it's a really nice tailwind to grow long term. So we think the question of how they compete against hub and net wealth, well, the data suggests that they are and have for at least 10 years, if not longer. The other piece is I sort of mentioned on the non-custody, so Scope Plus, they're the market leader. So that's dominant. They continue to grow it steadily. It's not a massively fast grower, but it's a consistent grower. I think that, like I said, is the business that got the interest of net wealth in the first place. Whether they're still interested or not is speculation. I'm not sure, but it's a good business, and it could be run at much higher margins if you integrate it with a larger business. So private equity would like it. That's one piece. The final point, and this is more recent on probably why the stock started to re-rate, I think, is that they've had 3 recent very material wins, and each one has been in each of their key product offerings, and all of them they've beaten Net Wealth and Hub24. So Bell's Financial, everyone knows Bell's, they're massive. They won for their Scope Plus offering. Morgans, which if they're not the biggest advisory network in Australia, they've got to be close. They're very large, particularly retail network. They won there for their SMA offering. They beat Hub and Net Wealth there too. And then in Spectrum, which is their wrap newer offering, which is small base but growing nicely, they won Euros. So those are 3 big wins. And at the 4-year results, management kind of indicated how significant they are when they said something along the lines of, if they can just onboard those 3 wins well, which you'd assume they can do, it's a risk, of course, but you'd assume they do it. And onboarding for this thing takes, not weeks, but months and years sometimes. It's slow. Advisors are slow to move money over, but it happens eventually. If they can do that, they do a good job of onboarding, those 3 wins alone will drive double-digit revenue growth over the next few years. And then you get whatever the market does, any other wins. But those are 3 really big tenders where they beat at least Net Wealth and Hub in those, and obviously some others. So, we can talk about valuations separately, but I think it's a business that's had a long track record of growth. It's got tailwinds behind it for a very long term. And it's actually winning against stocks that the market knows very well, and trading at a big discount to those peers. So it's probably a reason why we were interested.
Yeah. And I think, to maybe just drive home the point on the, gaining market share in a growing market. I mean, that's like kind of a double whammy. The market is growing and you're growing your share. So you're getting the double effect at the bottom line because of that. And I think, in terms of risks, obviously, I think we're in a very toppy market at the minute. I wouldn't be surprised if we, get a pause for a bit of breath here. I'm not calling a bear market. Never, as an investor in equities, would I be calling for a bear market. But I think, we have run pretty hard, pretty fast, kind of since Donald's Liberation Day, if you want to take that as the kind of point in time. So, a bit of a pause, wouldn't surprise me. And obviously, that kind of slows down the FUA a bit. But what are, if we were to think about risks for the premium business, a bit of a slowdown in the market, we get a bad, last 3, 4 months now, and it, kind of takes the cherry off the top maybe when the half year result comes out. Anything else you're kind of, keeping your eye on?
Look, I mean, you touched on the main one there, right? For if you in the short term, the market can go anywhere. There are some offsetting factors. It's not as simple, right? So if the market collapses like in an April, people trade, people rebalance. So transaction volumes go up and people put more in cash. And so they earn more on cash margin. So it's not a perfect comparison, but you're definitely right that if we had a real serious correction, not a 10% healthy correction, but a
Mm.
30% correction, then yeah, it's going to start to hit the top line. Like I said, on the non-custody side, that's not impacted. They're a per portfolio revenue model. So, of course, that's a downside if the market goes up 30%, because that business doesn't get the
Yeah.
extra clip, but it is what it is. Look, in terms of risks, probably one to highlight, and this is what actually allowed us to buy the stock at the first point, is that the clients are these advisory groups, and advisors regularly change the banner or dealer group that they operate under. And back in, it would have been late 2023, there was a group of well-regarded advisors, sufficiently well-regarded to be mentioned in the AFR when they moved. They moved from a group called Escala to another group called LGT Crestone. Now, that resulted in a lot of FUA gradually, took time, sort of bleeding out from those advisors and going elsewhere. Hit the stock, Praemium had to downgrade because of that, and it went unloved, like Laserbond is now. It's unloved and dumped, and that's when we started getting interested. Now, advisors move all the time. A really key point to highlight there is that advisors regularly switch, but because the group that the Escala advisors moved to, LGT Crestone, was a group that mandated one platform, they were forced to move the FUA off that platform. But there's lots of times when advisors have moved and kept those clients on platform, despite the new group using a different platform. And there's even been recent examples where, again, in the AFR, so they're well-regarded advisors with lots of FUA, have moved from one to another, and they're both premium clients, so it doesn't impact premium. So I think it's definitely a risk when advisors move, but I think the market overreacted to how often. There's not many groups that mandate one platform. Most of them, an independent group support whatever the advisor wants to operate on. So I think risk to keep in mind, but not as big a deal as the market thought it was in 2023. Beyond that, look, I think you sort of hit the nail on the head. They're growing market share within an overall market, but one of the key parts to our thesis is margin growth. So they're at 28% EBITDA margin FY25. We'd hope to be 30 plus this year, and then in time, mid-30s and ideally 40 when they get to scale, right? Which will happen eventually as the market grows and they grow too. But there's a risk there, right? So if they for whatever reason can't expand margins, then it won't earn the same multiple that a net wealth and hub, not necessarily, doesn't need to trade on their multiple to do very well, but it won't re-rate as strongly if they can't show that margin expansion. So it's probably a risk just to keep in mind and make sure that they hit. Beyond that, I think it's just management executing. We really like management. We think they've done a really good job. But they definitely need to onboard those 3 big wins. If that didn't happen, it'd be a problem. So we'd hope to see that. But beyond that, I think that's probably the key risk, Mark.
Yeah. And I mean, 3 big clients, great to get them, but trying to onboard them all at the one time or simultaneously, can put a strain internally
Yeah.
on resources as well. So I think you maybe that the execution of that one to watch out. One I wanted to touch on, I mean, you can't talk about financial services businesses in Australia without talking about regulation, given how much the government, whichever one you want, like to chop and change, and we just seen the treasurer roll back now the whole unrealized uh, tax on profits. There's another change now that's now well, never came and now is coming now in a different form. But we've had like royal commissions in financial services. All sorts of, especially at the advisor level. Changes around education and professionalism and the regulations all the time. So. Is there anything kind of that the premium guys are saying or that the industry itself is? I'm sure there's going to be a bit of IT work and stuff that's going to have to go on with the new or the proposed changes on the unrealized tax. I mean, it's still coming in, but for like kind of much larger balances and indexation and all of that. So the impact is less, but it's still going to impact some of these clients that are sitting on these platforms, and a bit of work is going to have to go into building a few bells and whistles to report on it correctly.
Oh, definitely. It's a good point. Regulatory risk for these business and for all these businesses is definitely a factor, particularly as the government, with super tax seem to be focusing on higher net worths. Premium is focused on high net worth clients. There'd be some very big clients sitting on their platforms. I think offsetting that is that it's the advisor's job, and particularly of a high net worth or an ultra high net worth advisor, to give good advice on how to structure things. And so uh, how would you say? I guess an advisor that sees those tax rules potentially coming should be in front of that client and advising them to move the money from super to a family trust or whatever it may be. But these are clients that are typically well advised, uh, sophisticated structures, and tax law is funny. I mean, tax lawyers are paid a fortune for a reason, but they're giving advice to optimize everybody's or wealthy people's tax in particular. So I don't view it as a massive risk to premium. If the super tax, the 3 mil cap and unrealized gains had to come in, I don't think it was an existential risk for premium. The fact that it's now changed, probably the biggest risk is just uncertainty, right? Like clients don't move, maybe money doesn't move until they know what's going to happen. So probably everyone just wants to know what the rules are and then they'll figure it out. Can cause risk in the short term, but we're not really there for the short term. Like I said, we think over the time it's going to grow, the market's going to grow, and Premium have demonstrated they can keep, ticking away with a bit more share. And if they can keep doing that, then I think we'll do really well out of it. But you're right, it's something to keep refreshing the AFR and make sure you're across whatever's coming next.
Yeah, no, exactly. But one of the things I did also want to touch on in Premium's case, you mentioned it earlier, one of the really kind of growth asset classes, I'll say it like that, is private debt, private credit. It's been a really hot space for I mean, at least 2 or 3 years now. And, it sounds like, Praemium having the ability to do a lot of this private stuff, the functionality may be better than what NetWealth and Hub have. Do you think that's kind of contributed to their kind of market share growth, given, a lot of these high net worth deals, or sorry, a lot of these deals, you have to be a high net worth, 702 sophisticated investor to even get access to a lot of this, private debt, private credit market that has, evolved into a pretty significant asset class for that type of client in the last couple of years.
No, definitely. I think the fact that they've spent 2 decades focusing on the high net worth segment is perfect for where the market is now. It is the fastest growing segment. It's where all advisors, I shouldn't say all, but many advisors, many even Hub and NetWealth, if you go and read their updates, they're saying we're focusing on the non-custody, high net worth, whole of wealth, which means every asset you own is incorporated into your platform. You get a consolidated statement on everything, assessing your performance, and also the really key part, which Premium has a big edge, which I think is hard to. I think you can just throw money at this to fix it, but is the tax piece. If you just own 100 stocks and they're all listed equities, the tax piece is very easy, and I'm sure simple software could do it. But if you've got assets all over the world in unlisted things, in venture capital funds and private equity funds and whatever it may be, it becomes a lot more difficult. So I think having exposure to that market really helps. Private credit, private equity, they've all done really well. Private credit is in the news at the moment for not good reasons. They're probably, selective collection of bad eggs. I think in the non-custody side, like let's take a worst case scenario. We're trying to think about the downside. If private credit had a big blow up, right? The non-custody side is mainly a per portfolio revenue model. So there wouldn't be a big drop in, while the FUA could drop potentially a little by a little bit. The revenue wouldn't change because it's just charging per the 60,000 plus portfolios that they've got on their platform. But it's something to be aware of. But I think that segment is where you want to be. And naturally over time, a lot that high net worth segment is growing because over time, I think one of the points that people were making is that the $3 million cap sounds high now, but a lot of 30-year-olds in 10, 20 years, that's going to capture a big portion of people. And so everyone's kind of that market's all moving up into premiums segment. A lot of people are going to want to have exposure to diversified assets and private assets and unlisted assets, which is why Hub and Netwealth are spending a fortune on pushing into it. And I don't want to downplay them; they're amazing businesses, and they've obviously made plenty of ground in the space, and I'm sure they keep Praemium on their toes. Obviously, Praemium have won those 3 big wins that I just mentioned, so they've had some early wins, but I bet they don't. Hub and Netwealth aren't going to stand still and let them win, so it's competitive, but they're doing something right, so we're happy.
Yeah. And I mean, the space is still growing,
Exactly.
you know, super contributions. I can't, was it this year or last year? They ticked up again, another 0.5% or whatever it was. So, there's still like
Yep.
quite big inflows into the industry more broadly. And as you say, the 3 million, if you turn, your a young buck like Harley there who started out in the industry not too long ago, when it's only yourself, you think, oh, 3 million is like miles away, but you get a bit further into like mid-career, you're married, you do a self-managed super fund, pile in 2 super funds, and maybe you get it on a bit longer, and you got like maybe the adult kids in there, 2 kids, you got 4 super funds in there. That 3 million comes up like very, very quickly when you do it across, uh, plus compounding and growth, and maybe a private business in there that is sold or doing pretty well, and the 3 million comes up pretty quick.
100%. I totally agree.
So I think, yeah, I think definitely in Praemium's case, just with the growth in private assets, and just people wanting to be a bit more diversified, and a bit bigger allocation to the privates, having a solution for advisors that takes away a lot of the pain, is definitely probably a key selling point, and maybe one of the reasons they got these 3 big clients.
Yeah, no, I think that's right. And then probably the last point on Premium to make there is just on valuation, right? Like it's really a nice sort of headline grab for me to say would be net wealth, for example, has 3 times the market share, but 15 or 17 times the market cap to make it, just highlights the valuation difference. That's probably not fair, right? It's very oversimplistic, right? I don't think we're going to wake up and Premium trades on net wealth multiple tomorrow. It does show the kind of accretion someone like net wealth or Hub could get from acquiring them. But on the multiple that Praemium's trading on, we just think it's cheap for the quality that it is. I think it's sort of 10 times EBITDA, 15 times cash EBIT, which is the metric we kind of focus on, at least on our numbers, and we'll see what happens for the rest of the year. But I think it's relatively cheap, but more importantly, it's in absolute terms reasonable price as well here.
Okay. Harley, we'll leave it there. Thanks very much for coming back and joining us.
Pleasure.
And yeah, as I said, two completely different industries. But I think, yeah, at the back of both of them, kind of good businesses that have maybe kind of flown under the radar here in a market where everything seems to be kind of up and to the right.
Pleasure to be here, mate. I really appreciate it. Enjoyed it.
And Harley, if anybody wants to get in touch with you for information about the fund, and or maybe wants to chat offline on some of the names we've talked about today or others in the portfolio, where should people go?
Yeah, we have actually just opened up for the first time in a while. We'll soft close for a while there.
Okay, cool.
But if anyone wants to chat, you can reach us at contact@hdcp.com.au. That'll come through to my email, website, hdcp.com.au as well. Always happy to chat stock ideas, or if you've got any, please send them through because we're always looking.
Yeah, and wholesale only, huh? Not retail.
Wholesale only, correct.
Wholesale only. Okay, cool. Great. Thanks, Harley.
Thanks, Mark.